Supermart.com.
Hello, Yup. With the unsettling events in the developed nations, what is the outlook for hard currency bonds and what are the implications to Asian hard currency bonds?
Well, if you look at the outlook for the US, I think recently data have improved significantly, whereas 6 months ago there was still a risk that there would be a recession in the US. I think currently most people don't see that as a base case scenario anymore. Unemployment has gone down significantly. We also saw a pickup of the housing starts in the US. All in all, we believe that GDP in the US will grow by 2.3% this year and 2.6% next year. So for the US, we are not that concerned, especially not about the impact of the growth in the US on Asia. If we then look at Europe, it's a different story. Obviously, Europe has a lot of issues at the moment. One of them is the slow growth, which we see especially this year, but also in the coming years, growth will be very low in Europe. The impact on Asia of that is, first of all, lower exports, obviously, from exporting Asian economies to Europe. That's a negative impact. However, if you look over the past couple of years, we've clearly seen the exports of Asian countries being a less important driver for the growth in the Asian economies. And that's a situation we expect to continue in the coming years. So it has been a less important driver for Asian economies. At the same time, we also know that if there's one region, and especially one country in the world which has the ammunition to stimulate the economy, then it is Asia, or as a country, China. Right, so if there will be a negative impact from lower exports to Europe, then Asia has the ammunition to stimulate growth for the region. So that's not really an issue. We think it's manageable, lower exports. The second impact of the situation in Europe is the European bank sector. European banks are focusing on strengthening of their balance sheets, which means deleveraging. They do that in their own region, but especially in their non-core regions, and Asia is one of them. Deleveraging of European banks in Europe means that there are tighter credit conditions at the moment. We saw that trend starting in the third quarter of last year already, that European banks started to delever in Asia. Fortunately, Asian banks are in a very healthy shape, so they are able to partly fill that gap. So we've seen that Singapore banks, for example, which are among the strongest in the world, have increased lending, taken over part of the lending which was previously being done by the European banks. But also Japanese banks and Australian banks are partly filling that gap. So also that, we think it's manageable, but it results in tighter credit conditions in Asia. What does that mean, tighter credit conditions? For some companies, the weaker companies, it will be more difficult to attract funding from the bank. And generally, funding costs will go up for the corporate sector. So that's not so good news. And that will result in more companies trying to focus on the capital of the bond markets to attract funding. So you see increased funding via the bond markets. So that's the impact of the deleveraging European banks. And then the third impact, I think that's the most important one, that's more the technical picture. In the scenario that we see that as a tail risk, so definitely not the base case scenario, but in the scenario that there would be a breakup of the Eurozone, for example, or a disorderly default of Greece, then obviously you'll see a decline in risk appetite amongst global investors, and that will have an impact on Asia as well. So that's not a fundamental impact on Asia, but more technical impact. The risk sentiment is declining, deteriorating, and that results in well, less appetite for risky assets, including Asian bonds.
What are some of the key items investors should take note of when they consider investing in Asian bond market this year?
Yeah, well, I mentioned already the fundamentals for Asia are quite strong. That's not only for the corporate sector, but also for the sovereign sector and for the banking system. So the fundamentals are quite strong. At the same time, we believe the valuation is attractive. Higher valuations, well, higher spreads or higher compensation for risk in Asia compared to the other regions. So those two are quite attractive at this point of time. However, investors should not forget the impact of the technicals of events which happen in the other regions. That can be in Asia, that can be in Europe, that can be in the US. Typically, the impact of shocks to the financial systems in other regions have a bigger impact on Asia than it has on the region where actually arise. So that's something to take into account. If you invest in Asian debt, the liquidity of the market is relatively low, and that results in relatively high volatility in times of stress.